The relationship between gold and bond yields may be changing forever. Historically, rising bond yields were bad news for gold, but something unusual is happening right now. The US 30-year Treasury yield has surged back toward the critical 5% level, and instead of collapsing, gold could potentially explode higher. So what does the market know that most investors don't? In today's video, we're going to break down this fascinating chart, explain why gold may actually benefit from higher long-term yields, and why the bond market itself could be warning us of a much bigger financial problem ahead. Let's get into it. So let's take a look at this chart. At the top, we have the US 30-year Treasury yield on the monthly time frame, and at the bottom we have the gold price. Now traditionally, when bond yields rise sharply, gold usually struggles. Why? Because higher yields make bonds more attractive to investors. And since gold doesn't pay interest, rising yields increase the opportunity cost of holding gold. That's been the traditional relationship for decades, but this chart is showing something very different. Look closely. Back in late 2023, the 30-year yield pushed toward the critical 5% level. At first, gold paused and consolidated, but then gold absolutely exploded higher. The chart highlights a move of over 65%. The same reaction occurred again back in May 2025. As the 30-year yield pushed towards the critical 5% level, gold paused and then exploded higher once again. The move again was over 61%. Now fast forward to today. Once again, the 30-year yield is approaching 5%. And once again, gold could be pausing for the next aggressive move higher. That's a huge macro signal, because gold is no longer reacting negatively to high yields. Instead, it may actually be reacting positively. So the big question is, why would gold rise with higher bond yields? Well, the answer may come down to one thing: confidence. You see, when long-term Treasury yields start moving toward extreme levels like 5%, the market may begin questioning the sustainability of the entire debt system. Governments around the world are carrying enormous debt loads, and the higher yields go, the more expensive it becomes to service that debt. That creates stress across the financial system. In other words, the market may no longer be seeing higher yields as healthy. Instead, the market may be interpreting higher yields as a warning sign, a warning that something in the bond market could eventually break. And when confidence in sovereign debt begins to weaken, investors often turn toward hard assets like gold, because gold carries no counterparty risk. It can't be printed, it can't be defaulted on, and throughout history, gold has acted as a form of monetary insurance during periods of instability. That's why this chart is so important. It suggests gold may now be trading less like a commodity and more like an alternative monetary asset. Now let's talk about why the 5% level matters so much. Psychologically and historically, 5% on the 30-year Treasury yield is a major level. Once yields start reaching these areas, financial conditions tighten aggressively. Mortgage rates rise, borrowing costs increase, government interest payments explode higher, and liquidity begins to tighten across the economy. Historically, when yields rise too far too fast, something usually breaks. That could be banking stress, recession fears, liquidity problems, or pressure inside financial markets. And here's where things get really interesting. If investors begin believing that central banks will eventually be forced to step in, whether through rate cuts, QE, or liquidity injections, then gold becomes extremely attractive, because gold tends to perform very well during periods of monetary easing and currency debasement. So ironically, the bond market becoming unstable may actually be one of the biggest bullish catalysts for gold over the next several years. Now, of course, nothing moves in a straight line. Gold can still experience pullbacks, especially if the US dollar strengthens or real yields move sharply higher. But structurally, this chart may be telling us something much bigger. It may be signaling a shift in the global financial system itself, a shift where rising yields are no longer bearish for gold, because the market is beginning to question the long-term sustainability of debt, currencies, and sovereign balance sheets. And if that's true, then gold's move may only be getting started. But as always, that's just one perspective on the market. Let me know your thoughts down in the comments below. Do you think gold continues higher from here? Or do you think rising yields eventually pressure gold lower again? If you enjoyed this breakdown, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss future weekly gold and macro market updates. Thanks for watching, and I'll see you in the next one.